You've built a successful life, but now what? Welcome to the Gen X Collective podcast. We're for men who are navigating midlife with purpose, health, wealth, family, work, and the mark you've made on the world. We're talking about the stuff that really matters with experts who have solutions, advice, and a sense of humor. And now, here's our host, Laurent Truc.
Welcome back to the Gen X Collective podcast, where we talk about health, wealth, family, and leadership for high-performing Gen X men navigating through life's pivots. Today, I'm with my co-host, Serge Jarlian. This episode is an absolute treat. Serge and I are also joined by someone who's helped thousands of Canadians get their financial lives in order, the legendary Rana Chauhan. He's a financial visionary, a powerful speaker, and a guy who spent decades helping people invest with clarity, confidence, and purpose. So today we're going to talk about how to silence the noise, ditch the fear, and build systems in investing, and probably help prepare your kids for more financial literature. So let's get in it. How you guys doing today?
Very good. Very good. Thank you for having me. Thank you for doing this.
We're very excited. I know you, Serge, and I have talked quite often, and it's always dynamic conversations. So looking forward to sharing that with our listeners today.
Absolutely. Very excited to have Rana on with us today.
So Rana, how about we start with a little bit of background? Love to hear. You have such an interesting way to get into the world of finance. Do you mind walking us through a little bit about your backstory?
Yeah, it's the classic go one way and end up somewhere else. Right. So brought up in England, basically started off doing sciences, medicine and physics. All right. Worked along that way and then moved to Canada. Didn't enjoy what I was doing. Then I decided to take the finance route, ended up in finance. Worked in the industry for a while. This is now going back to 1987, right? So I'm aging myself there, right? But the industry was going through a lot of challenges then, so we decided to open up a firm and then grew that. It did very well. It's based on some very simple concepts. One is, do what's the best there you can do it, tell the truth. Okay, and we built that firm. It became a huge firm. We were managing 30 billion in assets. Started off with zero. Oh, wow. All right. Then I decided to take time off because of certain events that had happened in my life, and then I decided to do it all over again. Go back to square one. All right, and rebuild it, but with all the lessons. All the mistakes and lessons that I learned from before not happening again. So that's been the journey.
That's great. How many years in finance?
Well, 87 is when I started.
Wow. That's a great journey going from medical to to this. Very cool.
Rana, what made you pivot to that? Like, what made you make that move from medical to finance? What happened in your life to kind of make that happen?
In medical, right, there's boundaries to it. Mm-hmm. Okay, in finance, there's really no boundaries. It's in your control more. Mm-hmm. All right, medicine isn't in your control. You get a serious illness, and especially on the side of the physicians, they can only treat cancer with chemo, all right, or something like that. Beyond that, they give up. Whereas with finance, you can actually have a broader impact. Because if you teach finance right and you change people's lives in many, many ways. They get to live a fulfilled life. They get to be with their families, their kids. Mm-hmm. And medicine is very you. It's independent. It's about you. But finance is about you and your kids and their kids and their kids and therefore. So I think it has a broader impact.
Yeah,
very cool.
Interesting.
So we'd love to talk a little bit about some of your philosophy. We talk a lot when we get together about fear and how do you invest through fear. Would love to understand your perspective on what you see from your clients and how you guys manage that.
Okay. Nick Murray is a financial educator, and I think he summarizes it best because investing is the lifelong challenge of fear of the future versus faith in the future. Okay, and that's it sounds kind of trivial, but it's actually a very, very deep message he's giving. So what we live constantly and are bombarded with is fear of the future. Mm-hmm. Okay, whatever it is, whether it's you get the political angle to it or some company coming in and everything, and yet we've survived literally everything to get to here. And you see that, we kind of succeed through it. So with that, I do believe that, we overemphasize the fear. Right? You don't ignore it, right? Because in fear, you find out certain issues that are there, but you got to realize they can be corrected. And that there's a process through it. Where fear becomes dangerous is when it stops you from doing something or correcting something. Okay, and that's what I believe in, that in the end, we survive, companies survive, and we've got to take advantage of that. So having faith in the future is a big thing, right? We had COVID. Let's go back to the 1300s. We had the Black Death, right? That killed half the population of the world, right, that time. And yet somehow we managed to survive even that. Right? So it's all about survivability.
Rana, it's interesting. I've followed you now for about 4 years, and we've been in a very volatile time as an investor. And we're all Gen Xers. We're getting close to that, retirement age. We're very thoughtful of where we put our money. It's been a crazy time, right? Even now, current volatility with tariffs and Donald Trump and wars. We've been through a lot, ups and downs. But what I love about what you talk about and what you bring to your listeners is cutting through what the reality is out there in the media. That's one of the things that the truth comes out. How do you navigate through that, and how do you see that take place within the media, and how to dissect that for investors like us?
Okay, I just want to take a step back because you said something very important that we've been through a lot.
Sure.
Serge, I want to remind you, your parents went through way more.
Sure. Yes.
Right?
No, that's true.
Yes.
They had to deal with you.
Sure.
Right. And they had to deal with everything else, right? They had world wars.
Yeah.
Okay, so the thing is, how do you deal with the fear? All right. You gut check your emotion. Your emotions are good. All right. Don't belittle them. All right. You gut check them though. You say, okay, is what is going on temporary, or is it a marked change going forward? And can the world adjust to it? So there's a lot of nonsense around tariffs. Okay, so you have to go back to the history of how these tariffs happened. Right? Tariffs were in place to encourage the growth of the world so that trade could happen. It happened after World War II. All right, to get the rest of the world to recover. It never got adjusted. All right, so right now it's seen as a fear, but whatever they do, if they do a tariff, companies will adjust. And we're at a spot right now where the adjustments are quicker. And by that I mean that you can, change prices, you can improve quality, okay, and you can implement tools that weren't there before, like AI as an example. There's going to be some changes, whether they're layoffs or not. This is why understanding finance at a very young age, and as parents, we've got to instill it in our kids. I remember very early on in my life when I was a student and I worked at a summer job. It was at a bacon factory, and bacon would fall, and I'd pick it up. And this guy comes up and he goes to me, "What are you doing?" And I goes, "Well, work, summer job." And he said the smartest thing that I've never forgotten. The day you're hired, plan for the day you're going to be fired. Now, I took that as, wait a minute, I'm going to get fired. But he goes, no. He goes, you have to start thinking that at some point in our lives, we're going to be fired. I was never fired, but it's going to happen at some point. So why not prepare a little bit for it now? And that's what started this lifelong journey about putting something aside. Whatever it was. Okay, like put something, and then eventually when you retire or something, you've eaten this elephant one little bite at a time, and then you're not fearful. So it comes down to the word planning and discipline and doing that. And life and the negativity of the world takes you away from that.
You made a comment around tariffs and how companies will have to pivot and make do. And we haven't seen this happen that often, so it's hard to go back and say, here's what happened in the 90s during tariffs. So I'm curious on your perspective, are there going to be a lot of collateral damage, like companies that just will not survive this on either side, US or Canada?
First of all, the future is unknowable. All right, let's just get that out of the table. I can't predict the future. All right, and it can get very, very complex. All right, so these are the truths of the world.
Yeah.
Okay, but every company is in there to survive. No company wants to die. All right, so there will be collateral damages. I don't know the amount, but I do know that when you're investing in a company, you're investing in its survivability. All right. There are companies that are not impacted as much by tariffs. I'll give you an example of it. I don't want to promote stocks or anything like this. I'm just giving you an example of some things. How do you put a tariff on Google? How do you put a tariff on a search? How do you put a tariff on Netflix? All right. So there are things that are, even data centers as much, if you think about it. AI, right? How did you put your tariff on ChatGPT? So there will be things that are, and then there are companies that will, Amazon will probably get some tariffs because it has goods flowing through. But what they'll do is they'll adjust themselves. So I believe in the survivability, all right, of companies and of us as people. Yes, there will definitely be collateral. There will be a change in the guard, as in layoffs. And again, I'm going to repeat, this is why having plans for these things earlier on matters so much, and instilling that in our children.
Do you, the media is constant right now, and it's hard for us to get away between the devices we have and, God, every time you turn on the TV. How do you use that to your advantage? Is good news, bad news? How do you manage that?
Okay, so first of all, I got to go back to Serge's parents. News was only at 9 o'clock at night. Right? They didn't have...
It was 1 hour news, yeah.
It's true.
They didn't have news. CBC at 6 or CBC at 9. They didn't have... So they could actually live their lives. We've got to do that now. So as an example, me personally, what I tend to do is only really pay attention to news at 9 o'clock. All right. And then I know, there's things that are happening in between, but I don't get caught up in it. So then at 9 o'clock, I'm allowed to digest it and say, okay, what in this message was really the truth and what was an opinion? Most of the times we're opinionated. Everybody's got an opinion for it. But if in the core of it, you look to the truth, okay, you'll see that, okay, well, first of all, we know April, whatever date, there's going to be a tariff on. That is the one thing. We do not know the amounts of it, right? We don't know how much it's going to be or what it's going to be. But then after that, something will happen. It'll adjust to it. And if you look at the one part of history that I really, really like is since roughly 1792, we've had a lot of problems in the world. You've had market crashes. But this one trick, it always recovered. And it always recovered higher. Now, it could take longer. That I don't know. So those moments of trauma in the financial world allow us to reassess and think about how do we take advantage of it. So the case is basically step away from the hype of the news, step away from the, what I call CNN, which is constant negative news, okay, and focus on what does this actually mean to me.
I like that.
Yeah, that's one of the things that I love about what you do, Rana, is you look at the news, which is very sensational, as it was probably in our parents' generation. But you almost give me that parental comfort to cut through that noise when I look at CNN or CNBC and really what is the underlying message. You even highlight some things that are in the media and then you actually show another side of maybe what the truth might be, right? There's something in between. That's what the media reports and what's actually happening within the finance world.
And I'll even bring something from the past that same media said and say,
Yes,
look,
exactly.
and here was the outcome, right, of what they said at that time. History is a great tool for us. It's not perfect. It's definitely not perfect. I believe it's like watching a movie, all right? So if you watch all these hero movies, right? Whether it's James Bond or it's an Arnold Schwarzenegger one and everything like that. Well, first things is there's always a trauma in there somewhere, right? And then somehow or the other, they manage to win at the end. Okay, something comes together, right? Well, that's kind of like the markets. There's always a trauma in there. Then somehow or other, they manage to, like, literally every single movie you look at, literally every single market event. So it's about having that confidence that, the world will work itself out. Adam Smith was the father of economics, and he believed in the good hand, right? That when trouble happens in the world comes together and they work together to solve that problem. And we saw that in COVID in bucket loads. All right. All the medical community got together, everything got together. We all isolated ourselves and we got through it. So again, it's that whole thing about survivability of us. We've got to build that in our children, because the problem with this constant negative, what I call the TikTok world, is that they're seeing so much more negative rather than positive.
Yeah.
And that affects their brains. Their brain cells don't come together coherently. The frontal cortex doesn't join and mesh rational thought until you're into your early 20s. So up until then, these teenagers, this is why teenagers go wild, because their frontal cortex isn't set yet.
I think Laurent and I have experience with that with our kids, right, Laurent?
Yes. It's been a fun year.
So it's our jobs to remind them, just like your parents did with you, that, you know what, if we get band together, we can survive. And I think that's an important role in the world of finance, especially.
So I like, let's stay on the topic of kids, because as Gen X men, where most of us are dads, and there was very little financial education in my upbringing, at least. And nowadays, I find it's almost the opposite, where they're getting bombarded, whether it be by TikTok, hey, do day trading, invest in this. And they have everybody's looking for a quick buck. There is no concept of long-term investing at my kid's age, at least, and he's 18. So what is some of the wisdom that we as Gen X dads can pass on to our kids?
I'm a little bit excited that they're actually doing something. All right. like rather than just sitting in front of the video screen, right? This is it. There is a lot of gambling mentality. So the way I would think about it is encourage them to do it, but let them make some mistakes in it. All right. But at a small scale. All right. Not at a large scale that it impacts their lives, but constantly remind them the reality is that there are going to be times that you're going to get disappointed, and it's okay. Let's sit down together and talk about what happened. So this whole journey of what they're going through, I mean, TikTok has a good and a bad side. It's actually getting them excited is good, but kind of bringing back the gambling mentality and the quick, get rich quick thinking it is the wrong thing in it. I mean, we had it when we were kids as well, right? I remember trying to flip baseball cards for money. Right? Well, that's essentially what they're trying to do.
It's part of the irrational side of being a teenager. We were always looking for a quick buck in our generation back when we were kids.
It is, but I find today they emulate some of these TikTokers that have made a lot of money. And so I find the selling gum for $1 to your friends at school could make you an extra $5-10 a week. These guys are looking to gamble much larger amounts, in my view. That's what I'm sensing and feeling.
Yeah, the TikTok does, or the not just TikTok, but all these things, the YouTubes, and there's no validation to this side. There's no validation to like, okay, is he really worth that much? Because you can literally say anything and people will believe it.
Sure.
And the advertising is they never tell you about their losses. Everybody's going to make losses. I've made losses. Everybody's made losses.
Yep.
It's how you understand and learn from the losses that moves you forward. If these TikTokers were so successful, they'd be owning Buckingham Palace. Right? So just realize that. Okay. And the problem with the world right now is the world lives on credit.
Yeah.
So a lot of things that you see on the video screens are these guys that make a bit of money and then they go out and lease a Lamborghini or a Ferrari. And then you have all the pictures, but you don't know the reality of it. So as parents, we've got to instill the systems, the habits, and get our kids to read. One of the best things that my father did to me was give me the love of books. And they didn't have audio books or anything like that then. All right. But I actually like the hard books and learning from them and people, and then try to discuss it afterwards, debate about it. What is this relevant? And as parents, we've got to give the level of education and books back to our kids.
I like that.
What are some techniques now? So Laurent has an 18-year-old, and Laurent, I think Maddie is 16? I forget.
She's 16 in a month.
16 in a month. I have a 14-year-old and a 12-year-old. Lots of years of wealth building in front of them. What are some techniques that you can give, us dads now to instill in our kids today, so that 20 years from now they have a bit of a nest egg?
So this is what I did with my kids. I gave them a bit of money and I said, whatever you earn from there, half of it you can spend, half of it we'll use for another day. Right? And it could be a small amount. So that it becomes homework and a project to them. And it's a project, it's a selfish project because, if they find a good company and so let's say I encourage dividends and growth earlier on. So the idea of they'll never look at dividends. Most kids will, it's too boring.
Yeah.
But when you put physical money in their hands and then 3 months later they get a check from that, all of a sudden that becomes their pocket money.
Yeah.
And then they start to realize, wait a minute, I'm going to get, every 3 months a check from these guys, and that's going to be my pocket money going forward.
Yes, my money's making money for me, which is the fundamental basis.
And then what you do is you find another company that gives a check in the previous month. So, you start with one company, does 3 months, let's say January and March, then you find, or January and April, then you find another one that does it in March. December and March. Then you find another one that does it the previous month. So all of a sudden, they start to see how something boring pays them each month.
Each month. That's great.
And that's a simple thing to do there.
Boring is not easy with teenagers, right? They have to be motivated, and seeing that cash in hand where they can go buy something with the money they invested is a fundamental shift in their thinking early on.
My rule was whatever you make, even with the student, half of it is for you to spend today. Half of it is for you to spend in the future. Like buy another dividend, buy something else. That way you get the concept of always realizing that there's two Laurents, Laurent of today and Laurent in the future. There's two Serges. And you've got to look after both.
I think there's also a side of boring and small compounds very nicely. So one of the challenges I have with my son is like, why am I going to invest in the market and get a small little return when I could go into crypto on one of these like crazy coins? I'm like, you have not played enough on the downside to understand how hard of a hit you can take. And so I showed him what compounding interest could look like. And when you show that over even a small, at their age, over 10, 15 years, the numbers start hitting them, and they make
Let
sense.
them experience both. Though.
Yes.
Because they're not going to listen to us. They listen to their friends. They listen to the phones. Okay.
Yeah.
And they'll believe them over believing you. So I always say, experience it, try it, make mistakes. But at the same time, here's the other thing. So split the choice, and then they'll realize it. Okay.
I didn't listen to my father too often when I was a teenager, but one thing that's stuck still to this day that I preach my kids is a saying that he always instilled in me, saying, you learn from your own pocket.
Yeah.
So they have to experience losses for them to feel the pain and the gains. So I like that preaching. It's still stuck.
Almost seems like the dating thing, right?
Yes, that's right. That's right. That's right.
Let's pivot a little bit. We had a conversation not too long ago, the three of us, around retirement and how to time, how to plan, how to figure out how much money you need. And you had a really unique, actually it's not a unique formula, but you just made it so concise and easy. And Serge and I were like, duh, like, well, why have we not been talking this way for years?
Yeah.
Can you kind of walk us through that again?
Yes. Every single person has what I call a golden number. All right. So basically, to me, you got to ask yourself, how, in a reasonable manner, how much money do I need in a month to survive, to live a good life? I'm not talking about, luxurious life, but just a decent life that I don't have to worry about things. So you take that number, all right, and you multiply it by 12 to get a yearly number. And then here's the key thing about it. You multiply that number by 25. I'll explain why 25. Because if you multiply any number by 25, 4% of that number is the initial number that you had. All right, so the X times 12 is 4% of the 25. That's how much income you're going to receive. All right, so take any number, 1,000 times 12, 120 times 25, that's going to pay you, 4% of that is going to be the 120. And you get paid that for the rest of your life. But that number can be very, very large. All right, so I'm going to say, let's call it 2 million as an example. You take some number, multiply by 12, then 25. Let's say it's 2 million.
Well, can we do an example just so that people can make it? So let's say you need $10,000 a month to be comfortable.
All right, so the 10,000, I'm doing it live right now, times 12 is equal to 120,000.
So I feel I need 120 grand to live as an
times
example.
25 is equal to 3 million.
Okay, so I need a nest egg of 3 million?
That's your golden number.
That's the golden number. Okay.
I didn't say that that's what you need to have. I just said that's the number that gets you your dream, because 0.04% of that is 120,000. But 3 million is a lot. So then you use the rule of 72, which tells you if you divide any number by 72, it tells you the number of years to double.
To double your money. Okay.
Double your money. So let's say the average return is 7, that means 10 years. So if you have 3 million at the end, 10 years before that at 7%, okay, now remember the markets do a little bit more than that. It's 7%, sorry, at 10 years before that, it's going to be 1.5 million. So that's 10 years.
To double, yeah, got
So
it.
3, if you're 1.5, it doubles, it becomes 3. Okay? Now, 1.5 is a lot as well. Okay? So I'm just going to do that quickly.
I'm
Okay.
the calculator as
Okay.
well.
We have any visuals, Rana, by any chance?
We can put that later, but
Yeah, okay.
700. So if you look at it, if half of that is going to be 750,000. So that's now 20 years. All right. So your target now becomes 750,000, not 3 million. Because if I can get to 750, then 10 years later it's going to be 1.5, and 10 years after that it's going to be 3.
Got it. So if I think I'm going to retire in 20 years and I feel I need $3 million at that time because 4%, say you average 4% in a very conservative way, you're going to produce your $120,000 a year and you'll live comfortably. So to do that, 3 million in 20 years is like having 750 today.
Yeah.
Okay.
Or you can break it down even further, right? If I look at the 750 rate, 750, and I divide that by 2, I need 375. That gives you 30 years.
Got it.
But here's the key thing. I gave you 7%. So the idea is to include growth. So this was taught to me by a very famous billionaire, right? His name was Tom Moscow. He's a bit of he said, the secret to good investing is concentration and then focus on growth. And he compounded 17% and above.
On average.
On average.
Wow.
So
That's a
put-
massive return in
Yes.
different,
So that
closer
puts
to
you-
retirement very quickly.
So that puts your doubling period at 4 years.
Yeah.
So now all of a sudden, I mean, he's demonstrated it's historic. Or you take any one of the famous investors, you take Berkshire Hathaway, you take Warren Buffett, any one of them, they compound greater than the money. That doesn't mean that you're not going to have losses. It comes to understanding how to take advantage of a down period in the market. And that's
Rana-
just systemizing it.
Yeah, Rana, this is a topic I'm really passionate about. Rate of return. We're all trying to be financially independent into our, call it, close to retirement years or into our retirement years, where we don't want to be tied to a job or a business and really doing things like this or other things that really we're passionate about. So rate of return is a huge aspect of that, getting to that financial freedom. You talk about 17%. There's a lot of different techniques. There's the quick way, which doesn't kind of lead to that. But what are some of the investment philosophies you and your firm currently use to kind of look at the market out there? Like what makes kind of you guys different and your philosophy different than a lot of what others do out there from a investing style perspective?
Okay, so first of all, we believe in concentration. Concentration, what it means is a fewer number of companies, but really good companies, companies that people will know, and companies that are growing, all right, doing something good in the world of building, right? Not stale companies or something like that. So we're constantly looking at that. And concentration is between 8 stocks to 20 stocks, not 100. Not 200, not 1,000, not an index. Because if you think about all those people that are 100 stocks, and you ask them, tell me what 95, stock number 95 meant to you.
Yeah.
All right. Well, if it's really good, why wouldn't you put more money into the stronger one? And this is what all the successful investors have done. They've concentrated.
Yeah.
All right. Even Warren Buffett has like 70% of his portfolio in four stocks. Actually, it's five, closer now. But so that's the bulk of it. So concentration is one thing that we believe. Then we believe in being agnostic to style. So what does that mean? Most people think of value investing or growth investing. To me, they're basically the same thing. You're not going to buy something cheap if it's not going to grow. So it's just a matter of which price point you buy it at. So we're agnostic to it. We just want a good business that can grow, and you'll put a little bit in now, and then when it drops further, you can buy more because it's still growing. All right. And so that's kind of our mentality. And then we rebalance. All right. So we'll constantly take some profits of something that's gone up too far, a little bit, and sometimes park that on the side because we know that there are going to be down days. We believe in seasonality, just like we have, winter, spring, summer, and fall. The investment world has that as well. All right. So we believe in understanding seasonality of investing. People have to do their RRSPs. When do they do them? They mostly do them in March. So there's going to be, if there's a market drop, they're going to add in, and then you'll see the results a little bit later. The good thing about the world is that there's Christmas, and it's the same around the world, December 25th. So just before that, the kids are going to be badgering dad to buy us presents. So you're going to see a lot of spending towards that. Okay, so knowing that there is a cycle to things, and everybody's going to go, most people are going to go vacation in the summer. So that's going to be an event. Yeah. So seasonality plus concentration plus being style agnostic, that's our main foundation.
You also talk about a theory I've never heard of within investing. It's called game theory. Can you explain to the layman how you apply game theory and what that is?
Yeah, I absolutely love game theory. Okay, so I got my master's in finance from University of London there, and it was primarily in game theory. Game theory is the way to make correct decisions. And decisions such that if any event happens, you have a process for it. And I know there's this movie, A Beautiful Mind, which talks about John Nash. Okay, and the Nash equivalent is that you make a decision such that no matter what happens, that was the single best decision. All right, that's basically what his proposal was. Okay, that's it. So in investing, like anything in life, we have to make decisions. So there's many techniques to making decisions. All right, I'll give you the one that you probably know is Rocky Balboa. His game theory was called rope-a-dope, which was basically hit me so hard that you get exhausted. So at the end of it, I come back and smash you. Every Rocky movie is built of rope-a-dope. Yeah. That's game theory. Do you see? So in the investment world, you also have game theory in that if the markets are going down, there is an exhaustion to the markets going down. And then when it gets to that exhaustion point, that's when you come back heavier and you invest heavier in those then. And you don't know when it's going to happen. So you use dollar cost averaging. But as soon as you start to see it pick up again, you accelerate the dollar cost average. That's Rocky, pounding Drago even more. All right. So if you want to look at tariffs, think of Drago as the tariffs hitting the markets.
Well, you also have to have some cash on the side for you to be able to deploy that strategy. So that's where the expertise comes in, correct?
Right. Don't you like dividends then?
Yeah. True.
Yeah, that's true.
Right. So your portfolio should have some companies that are growing and some companies that are giving dividends. And you take from the growth every so often to pile back into the dividends. Because the dividends are going to pay you the check when you want it the most. All right. None of these problems come at the time that you want them. Right? It will come at the worst possible time because you've made expectations of, wow, I've made 20% a year. It's going to carry on like that. I'm going to comp. And then you get something that upsets you. And then all of a sudden we're down. Well, if you had the dividends coming in, then at least on this date, I will have that check and I can take advantage of the growth one there.
Yeah.
So you need that combination.
Yeah, Laurent and our group have tried a lot of different investing styles, and there's always a curveball that's thrown your way, either through real estate investing, foreign real estate investing, or stock market. There's always a curveball coming, and you don't know when it's going to come.
No free money.
This is why game theory is so important, and I'm a huge believer in everybody that is a good investor is a good game theorist. All right, and in the game theory that I'm giving you is you're going to be wrong. Game theory says that the best game theorist will only be right 70% of the time. 30% you're going to be wrong. And it's putting in a system such that 30% doesn't harm you and doing all the possible analysis and everything you can do to make that 70% into an 80%. And here's the history of the markets. The history of the markets is that since the beginning of the time of the markets, they've gone 70% up, 30% down. So when they drop very fast, and then they recover slowly, but they always recover more. So you can use that game theory of 70-30 in your perspective to help you get through that. And then if you look at certain periods in time, this is what's called a post-election year. If you look at the history of post-election year, they're 80% to 90% positive, 10% negative. So now you've just taken advantage of history. So when you have a drop like what you're seeing in the markets now, knowing that statistics is on your side, you can add a little bit to it to take it around. And you don't have to add a lot, honestly. Because, even if you're adding a tiny bit to now, the fact that you're accelerating further up, all right, it gives you a greater emphasis to that because you're actually, buying a little bit. So it don't ever look at the amount I'm doing. All right. Look at how am I changing this whole thing. This is how George Soros actually built his wealth. And it's called reflexivity.
This was when we first started talking, this was so enlightening because there's so many strategies out there. And until you start talking to people about what kind of returns they get, you don't know what you should be targeting, right? You hear, hey, buy an index fund, you'll average 8 to 10, it depends on the market. Others are like, no, be super conservative, but look for, stocks that will pay you dividends. And then, only when Serge, myself, and the rest of our group started talking, like, what kind of returns are you guys getting? Do we understand that there are different philosophies and different things? And Serge, to your point, like, compounding is massive. And when you have a couple of down years, it hurts dramatically on your calculation of when can I retire. So Rana, I love your concept of, and only since I've talked to you is this whole like be very focused on a few stocks. Because for a lot of people, it's like, well, who's got the time to do that, right? But there are avenues out there like your firm and others that will make the time for you. So it's been very enlightening for me to hear that and understand like there's a lot of different ways to slice this thing. How do you view today's market in terms of there's crazy volatility and anticipated further volatility? Do you get even more laser focused on a couple of stocks? Do you diversify more? Like what are you going through right now?
Here's where medicine helps you. All right. Medicine is not reacting to an infection or anything like that. It's understanding the causes of it. Right. So any disease, a physician will try to understand the cause, then they'll have a treatment plan that's built into it, and then it's monitoring that treatment plan. So you can react to this market, or you can look at the core reason for it. And I know we're told it's tariffs and all that side, but that's not the truth. The fact is that since COVID, the amount of options available in the market has increased. So people sat at home and they said, how can I be rich? Well, I'm going to take a course in options. Right? And then options, they gambled. And some made a lot of money. Then when it fell, they lost a lot of money. So we're in extreme option and leverage phase right now. So we had 2 years of great numbers, 20% plus markets. So the amount of people doing options just accumulated. Well, the people selling you these options, what they call market makers or brokers, they don't want to lose money. So if the market's going up, they call them calls. Okay, it's getting a little bit technical. So somebody buys an option in the hope that it goes higher, and they pay for it. The market makers will take a piece of news, now let's call it DeepSeek, all right, as an example here, or tariff news, which hasn't happened, and he's talked about it since, October last year. So it's not a new news event, and then they'll hype it up, and that will cause people to sell. And because options are so leveraged, when you sell a little bit, it sort of like creates a negative, and then the people that are borrowing margined, they have to sell it, and that causes a greater sell. And that happens until the next options expiry date. So you saw this massive drop happen from February 19th to basically March 21, and then you get the overflow of that. And that's the cleaning out of the speculators. The good piece of news that nobody's talking about is that in the world there are pension funds, investment funds, and they have to rebalance back to their mix by law. So, 60-40 or whatever it is. If the equity market falls down, they have to sell some of their bonds to buy back the equities. So you got a forced big buyer. So that's why when I look at it, I look at the rational point of view. Why did this happen? Because we had 2 great years. Speculation's taken out. Now that speculation's being cleaned out, I have another buyer coming in who can slowly build it back up again. And the good point is, post-election years, 90% of the time are positive. And they have been worse than this point in time in history.
Okay.
Rana, what's your perspective on the market's volatility when it comes to the market makers? I think in one of your messages last week, you were saying JP Morgan made north of $2 billion in trading revenue. $3 billion.
Yep.
Yeah, versus like the retail investor, like who's actually affecting the market and the market sentiment?
Yeah, you've got to know, in game theory, it's know the players and know the biases and what's going to happen. That's why game theory matters so much. All right, and I know you had asked me about some books on this one. The market makers are going to try to profit from you at the maximum they can because they've got to create earnings. They have to pay bills. And you're an individual, so you're collateral damage here. All right? But the collective collateral damage helped them by 3.3 billion. So my perspective is, why wouldn't I just own JP Morgan?
Yep.
Because they're going to make 3.3 billion. That's going to show up in an earnings later on. And JP Morgan is the biggest bank in the US, one of the biggest in the world, right? Probably the biggest without government help, if you look at it, because the Chinese ones are with government help. So why wouldn't I participate in that side of it? All right? And you can benefit from there for it. So it's not about being afraid of market makers. All right? It's also saying, how can I profit from that market maker?
Very interesting.
Yeah, that's one of the reasons why we started, speaking to you and why I've personally invested some of my dollars into your firm is because for a lot of us, we have diverse backgrounds when it comes to financial maturity. Some deal with their typical, banking investment firm. Some do some investing themselves in ETFs and other things. But it's the education piece that I find the most fascinating with you and your firm is that there's a guidance. There's almost like advice and guidance that comes with that, with feedback like this and other webinars that your firm currently holds. that gives me that comfort to cut through that noise to figure out what is the truth and what is the reality, or the fake news that's kind of really out there. So everyone, again, make your own decisions, but there's the firms out there that are doing good things in a very honest way, and that's one of the reasons I love working with you guys.
We believe in full transparency. We do not believe in hiding anything at all. We have a free monthly educational webinar on where we think everything is going. It's at no cost to you. It's at a cost to us, but no cost to you, the listener. And you don't have to be a client for it. We also give at the beginning of the month an update on everything we did in the previous month. So if you want to follow it or do it yourself, God bless you. We just want everybody to do better, however, which format you use. All right. It doesn't have to come to us. It can go to any way you want, but just do better with your families. We have a motto, believe in the good in the world. To believe in the good in the world, first you have to be the good. So be good, do good. All right. And we're just spreading, we have a positive psychology side to our firm, and no investment firm has that. And I want to infuse that into everything that we do.
That's great. Just as we're closing out here, other than you as a resource, any other resource that you suggest people in kind of our age group should look up?
I like reading books and everything like that. So there's books that have changed my life. The first book, the most important book when it comes to investing, and I actually have it here. I don't know if you can. It's called Contrarian Investment Strategies by David Dreaman. This is an extremely famous investor, Canadian from Winnipeg, who became a legend in the U.S. there. Absolutely phenomenal book. It changed my whole mind on thinking there. And the other one that I believe is the most important one is this book called The Art of Strategy, all right? And there it is. And it's by Avinash Dixit. And it's about game theory, but in every part of our lives, from our schooling with the kids to driving your car to getting stuck in traffic. Your mind will change and you'll see everything as part of a game theory. And you'll understand when a market drops, what part of that is game theory. So I would strongly recommend those.
Those are great. Appreciate that.
And not an audiobook, because you can't make notes in them.
Any last words of wisdom? So Gen X's, here's just things to consider.
My thing with the Gen X's is your main role is to be a role model to your children. They see everything you do. All right. The one legacy that we have, it's not the money, it's not our houses, it's not our cars, it's actually our children. All right. And the good that we do them. So if we can teach them through experience and everything, and constantly bring them and discuss about finances, not just the finances of stocks, but also how are you going to pay for your bills? What happens after marriage? All these stocks earlier on rather than later. Okay, then we'll be better off. We have that birds and bees talk with our kids, but why not have the dollars and cents talk with the kids at the same time?
That's true. Having well-rounded kids, right? So mental health, physical health, financial health is important to teach at an early age. I know we have, as we're recording this, we have a live event coming up May 29th that you're going to speak at. So thank you for that, Rana, and thank you obviously for your time today. Maybe a little bit of a plug of what's upcoming in your economic update coming up in our live event in a few weeks.
I always talk about the bad, the good, and what now. All right. And that's what we'll be talking about. And the good thing, will be a lot of Q&A there as well. Okay. But we'll bring the reality of an event. And we've got to get out of this, what the media or whoever's perception is. This is bad. This person is bad. All right. And get out of that, because that's not going to help you make a decision. It's going to make you emotionally one way or the other way. All right. And you've got to step out of that and say, how do I benefit from whatever happens? How does my family benefit? What can I do? How can I pivot? All right. What's reality and what's fakery? But we'll be talking a lot about that.
That's exciting.
Excellent.
Can't wait.
Well, Rana, I think there's probably a million other topics that we should have covered and wanted to cover. So we will definitely have you
I'm
back
just going to
on.
have one other plug.
Yeah,
I'm
please.
also going to tell Serge at the stage there how to remove that guy called Bill out of your life.
Yes, absolutely.
We should do a full other podcast around how to get bills out of the way and automation. You have some really great ideas on that. So, and I know you were open to doing more of these sessions. So maybe that's something that we do live with the group. I think that could be a lot of fun. So,
Absolutely.
awesome. Rana, thanks so much for
Thank
your
you
time
very
today.
much.
And
Thank you, Rana.
putting this all together for us.
All
We
right,
appreciate
stay
it.
best. Thank you
We'll
very
talk
much.
soon.
Okay,
Bye.
all the best.